In our previous lesson, we compared the relationship between GDP growth rates percentage-wise and vacancy rates percentage-wise, but we used only 9 samples. Our observations was with only 9 samples, so the results was not statistically significant. So in this occasion, we will analyze the relationship between US dollar and Canadian dollar exchange rate and WTI crude oil prices using daily data and a simple linear regression framework. This is the formula. Oh, sorry, this is the formula. Copy and paste. These are the formula that is normally used for regression, for correlation and regression analysis. So, but we're not going to do this part. The correlation coefficient, we can use Excel to calculate. Correlation will be this array, comma, and this array, and we enter. So we can see, let's move this a little bit to the right. So our R shows, our correlation shows a negative relation. That means when one goes up, when one variable goes up, the other one goes down. I will change the color because this is a very significant value. Now, to calculate B, we need the standard deviation of Y and the standard deviation of X. And that's this, and X that's it. So with these values, we can calculate very easy our B value for the equation. So B is equal to R times the standard deviation of Y divided by the standard deviation of X. Okay, finally, to calculate A, we need the mean of Y and the mean of X. So the mean of Y will be simply this, and the mean of X will be simply this. So now that we have all the values, we can calculate our A value or the y-intercept. Let's pull this a little bit down, yes. So A is equal to what? A is equal to the mean of Y minus Bx, the mean of Y minus B times X. There we are. So now we can write our equation, our most important equation, but we'll define this relationship. Y equals Bx, which is minus 53.04x plus 146.4. Let's increase the font. because this is a very important equation. Okay. Now, we can see if these values that were calculated manually are correct by using the regression tool in the data function of Excel. So insert, let's go home. Data analysis, we have regression, okay, and we will select this. Oh, sorry, this is the Y is, the Y is, let's go up. The Y is the crude oil, right? And the X is the Canadian dollar. There we are. And it will be shown in a new worksheet. Okay, so there we are. We can out of it the selection. Yes. So see, we confirm exactly the values that we just found using the manual calculation, huh? Here we can see minus 53.04 is the slope, and when x is 0, the intercept, the y-intercept is 146.4, and this is exactly what was confirmed here. Now, let's do the interpretation. The negative slope coefficient, okay, indicates an inverse relationship between the exchange rate and oil prices. Specifically, when USD increases, meaning the US dollar strengthens and the Canadian dollar depreciates, WTI prices tend to decline. Tend to decline. Don't forget that here, our in Y, what is Y? Y is WTI, the crude oil, and X is the USD and Canadian dollar, the exchange rate. So at first glance, the magnitude of the coefficient appears quite large, right? A literal interpretation suggests that 1 unit here, 1 unit increase in USD CAD is associated with a $53 decline in WTI prices. Now, this interpretation is economically misleading because US dollar CAD does not move by 1 full unit under normal market condition unless we have a black swan or something incredible, right? In practice, exchange rates move in much smaller increments, typically in hundredths or tenths. So when interpreted correctly, the coefficient implies that a 0.01 increase in US dollar, Canadian dollar, the exchange rate, for example, from 130 to 131, 1.30 to 1.31, is associated with an average of 0.53 decrease in crude oil prices. A more substantial 0.1 increase in US dollar, Canadian dollar will match a $5.35 decrease in crude oil. Interpreted this way, the magnitude of the relationship is economically reasonable. Canada is a major oil exporter, and rising oil prices tend to strengthen the Canadian dollar, while falling oil prices tend to weaken it. The regression captures this inverse because it's negative, this inverse relationship. From a statistical perspective, the estimated slope is highly significant. This is the slope. The p-value is effectively zero. You have here to the minus 70 and to the minus 19. And F statistics strongly rejects the null hypothesis that the coefficient is equal to zero. This indicates that the negative relationship is not due to random chance. This is very important. However, this is critical, this part. The explanatory power or predictive power of the model is modest. Why? Look at this number here. The R square is approximately 6%, meaning that changes in US dollar against the Canadian dollar explain about 6% of the daily variation in crude oil prices. Only 6%. This is expected in high-frequency financial data, where prices are influenced by many additional factors such as global demand, geopolitical events, inventories, presentiment. Therefore, the correct conclusion is not that the exchange rates determine oil prices, but rather that there exists a statistically significant and economically meaningful association between the two variables. Okay, I hope this lesson will prove helpful. Thank you.